Well, hello to the baby boomers out there, also known as the retirement bulge. So if you're a baby boomer, either you're just about to retire or you've just retired. And you want to know something? With the market staying or remaining very volatile, Chinese-American trade negotiations going awry, there is a lot to worry about and a lot of volatility to keep you up at night. And if you're worried about your investments and you're looking for a solution about how to invest, how you could stay invested without panic or knee-jerk reactions, then this video is for you. First of all, if we haven't met yet, my name is Mitch Goldberg. I'm a financial advisor and a business owner, and this YouTube channel is about financial education. Today, we're going to talk about investing. More specifically, how should baby boomers invest? So the volatility continues, and you couldn't be blamed for wanting to maybe sell out of long-term positions or adjust your long-term investment and financial plan, or do this and do that. But you know something? Think twice before you make a knee-jerk reaction, because presumably your investment plan has already taken into account the possibility of massive volatility. So we have things like the $2 billion infrastructure plan that looks like it just went down the drain. We have the ongoing problems with Chinese trade negotiations, and these are starting to wreak havoc in the market. And if it feels like the market just goes down and down and down lately, well, that's because it's been going down and down and down lately. Okay, so here's what I recommend to my clients as a way to keep them engaged with their portfolio, to keep them invested according to their time horizon, risk tolerance, and financial goals, and to do this in a way that they can stick with. So first of all, an investment plan is no good. A financial plan is no good if you can't stick to it. So it's up to me to make sure I find something that is palatable for my clients so that when we do run into trouble in the market, it's more like, oh yeah, hey, this is what we expected. The possibility of this happening is built into our expectations. It's built into the possibility of how my account can do. So this is something that I do for clients, is I take a three-prong or three-bucket approach to investing their assets. So for example, we know we need growth over the long term from assets like stocks, real estate investment trusts, also known as REITs. We know we need these over the long term to stay ahead of inflation and to keep your account growing over time. But we also know that there's money we're going to need over the next 5 or 10 years. And then we have our immediate needs for assets right now. You know, our emergency reserve fund, funds that throw up some kind of passive income, either dividends or interest from bonds. And what this does for clients is it puts things in perspective where you say, well, I realize my growth account is down because, hey, look, we're having another down week in the market now. So if you have a portfolio for the long term, it's almost like saying, you know, don't worry about it. It's here. This is one portion of your portfolio. It's for a very long period out that when you're going to need it, and that's your growth funds. And over the intermediate term, we have another portfolio, another bucket, if you will, of assets for the intermediate term. And then over here, we have your short-term investment needs, your short-term cash flow needs, your emergency fund. Those are already taken care of. So if you look at that, at least, hey, that's holding up well in the market. It's holding up well at a time of high volatility and a ton of geopolitical things taking place right now. And that actually helps people stick with their, I find, stick with their investments a lot better. The other reason why I like this approach so much is because of the flexibility for rebalancing. So when I work with my clients in these kinds of portfolios, whether if it's individual securities, exchange traded funds, or mutual funds, the point is I can actually rebalance the internally, I can rebalance each bucket. So as different portions of the each bucket go up and down, I rebalance, and that helps make the ride a little smoother over time. It helps dampen volatility. But another advantage is I can actually rebalance between buckets. So let's say, for example, your short-term bucket is 50% of your portfolio, your intermediate-term bucket is 30% of your portfolio, long-term 20%. Now, if your long-term portion goes up to 30% because of a strong bull market, we can actually shave that down back to 20% of the overall portfolio and use the proceeds from that to rebalance the other portions of your portfolio. When I talk to my clients, in particular baby boomers, pre-retirees, and retirees, I want to make sure that they have an investment plan that they could stick with, and the three-bucket or three-prong approach to me has been a very effective way to do this. Thanks so much for watching. If you liked the video, please give it a thumbs up. Please subscribe to my YouTube channel. If you have any questions about your portfolio, you are welcome to contact me. My contact information can be found at clientfirststrategy.com. And until next time, thank you so much for watching.